Hello and welcome to part 2 of the lecture for chapter 10 and the last lecture for this class. So in this lecture I'm going to talk about intangible assets. So those are assets that we can't see or touch, but they still have value and we own them. Let's talk about that a little bit, and then I will talk about disposing of assets, including exchanging similar assets. So first of all, intangible assets. Like I mentioned, they don't physically exist. We can't see them or touch them, but we do own them and they do give value to the company. So a couple of these two are going to be amortized over their useful life. So we'll spread the cost of the patent or the cost of the copyright over its useful life, and that's called amortization. Similar to depreciation, but this is amortization. So patents are the exclusive right that the government grants to a company for a new invention. So if you invent something that hasn't existed before and you go through the process of applying for a patent, which is expensive and time consuming, if the government awards you that patent, then you take all of the costs associated with earning that patent, and that's your asset, and you spread it over the life of the patent. That gives a company effectively a monopoly on a particular product they invent. Nobody else can sell that for that period of time. Copyright is similar, but it applies to published works, so like books and songs and poetry and things like that. That's for the life of, that's extended, but I should mention patents are good for 20 years. Copyrights are good for the life of the author plus 70 years. Next one is trademarks like Coca-Cola or Apple or the Nike swoosh. Those are marks that intend to identify a company or a product. They have an unlimited life. As long as you continue to use the trademark and show that, they continue to be protected and have value. So we don't amortize trademarks. So when we do amortize assets, intangible assets, like I mentioned, patents and copyrights, we're going to recognize amortization expense, and then we're going to credit the asset, or we're going to credit an accumulated amortization account. So goodwill is another type of intangible asset that a lot of students get confused about. So goodwill only arises through the transfer of a business, somebody buying or selling a business. So it's an arm's length determination. And it's the difference between the net market value of your assets compared to what is actually being paid for the business. So let's say you own a restaurant, and the market value of the tables and chairs and silverware and kitchen equipment, let's just say it's $200,000, and you have $50,000 in debt. So if I were going to buy your business, the net market value of the assets would be $150,000. That would be the value of the net assets, the $200,000 you have in value of your equipment minus the $50,000 you owe to suppliers. So that would be $150,000. Well, your business might have a great reputation. It might be booked solid every night, getting great reviews in magazines and all of that. And it might be really, really popular. You might have a great staff that, the place basically runs itself. If that's the case, you're going to want more than $150,000 for your business. And as a buyer, I'd be willing to pay more. If I paid $200,000 for your business, that extra $50,000 that I'm paying is associated with goodwill. So it's the value of your reputation and the system you have in place to make money. So that's going to be an asset on the buyer's books. So goodwill will only arise through the transfer of a business like that. So now on to disposing of fixed assets. So if an asset's no longer used, we might sell it or discard it. If the asset is completely depreciated, so there was no residual value and we've depreciated it completely, then we just strip that asset from the books by debiting accumulated depreciation and crediting equipment for the full amount of those two accounts for that particular asset. So in that case, there's no gain or loss because there's no book value to lose. Now, if it hasn't been fully depreciated, then we would take the depreciation up to the point at which we discard it. So we would prorate an annual depreciation amount for the amount of time we use the asset. And then we'd remove it. So if we didn't receive anything in return, if we just took the equipment to the dump and got rid of it, then the loss would be equal to the remaining book value in that asset. We would credit the equipment, we debit accumulated depreciation. The difference between the two is $1,200. That would be a loss on the disposal of equipment. A loss or gain on disposal of equipment is determined by taking the proceeds of the sale minus the book value. In this case, the proceeds are zero. We just threw away the equipment, and the book value was $1,200, so the loss is $1,200. So the asset sold not fully depreciated, so we should take the depreciation for the year. If we sell it for the residual value, then there's no gain or loss. So in this example here, the residual value or scrap value is $2,250. We sold it for $2,250, no gain or loss. Proceeds minus book value equals zero. So if we sell it for more than book value, say we get $2,800 for it, we'll record the receipt of $2,800 of cash. We'll wipe out the accumulated depreciation, which again is normally a credit balance, so it takes a debit to get rid of it. We'll credit equipment for our original cost, and in this case we have a credit left over to balance the entry, so we have gain on sale of equipment of $550. That $550 is the difference between the book value of $2,250, if I remember correctly, and the amount of cash we received of $2,800. Proceeds minus book value equal gain or loss. Now, if we sell it for less than $2,250, in this case, in the bottom entry, we sold it for $1,000 cash, I'd record the receipt of the cash. I'd wipe out my accumulated depreciation. Here I'd record a loss. Proceeds of $1,000 minus book value of $2,250 is a $1,250 negative number or loss. So I debit loss. Gains are always credits. Losses are always debits. And then I credit equipment for $10,000. And when you have an entry with a few moving parts like this, it's really a good idea to stop and make sure total debits equal total credits before you move on. Now here's what the presentation of fixed assets will look like on the balance sheet. Remember, land does not depreciate, so because it doesn't decrease, it doesn't wear out, so we don't depreciate land, but you can see buildings, we show our initial cost minus accumulated depreciation for that category of assets, and then we show a net amount. And then office equipment, we show at our initial cost of $350 minus accumulated depreciation of $102 for a book value of $248,000. I total that as total property, plant, and equipment, and then separate from that, I show intangible assets, and they're shown net of amortization in this example. So exchanging similar assets happens all the time. We might trade in a forklift on a new forklift, or trade in a machine on a new machine, or trade in a truck on a new truck. So if that's the case, we're going to be offered a trade-in allowance for the old equipment. So if we take the truck in and say we want to buy a new $50,000 truck, they may give us a trade-in value of $40,000 on our old truck as an example. So what we're going to describe here is just applies to transactions with a commercial substance. So that means that we're not just trading assets, something is being exchanged in addition to that. So there are three steps here. So one, record the depreciation up to the date of exchange. So we have it depreciated up to that point. We determine if there is a gain or a loss. Remember, that's proceeds minus book value. Okay. And then we record the transaction. And there's four things we want to record in this transaction. We want to put the new asset on the books. We want to remove the old asset, which is going to require debiting accumulated depreciation and crediting the asset. We're going to record the payment of cash. So we're paying money in addition to trading in an asset, so we're going to credit cash. And then we recognize that gain or loss, and remember, gains are credit, losses are debits. And then we check to make sure the entry lines up, that debits equal credits. So here's an example. We have a new piece of equipment that's valued at $5,000. Somebody's giving us a trade-in allowance on our old equipment of $1,100, so we're going to need to pay $3,900 and give them our old piece of equipment. So in determining the cost of the traded-in equipment, the cost of the old equipment was $4,000. Accumulated depreciation at date of exchange was $3,200. So the book value at the date of exchange was $800. So I can look here and say they're giving me a trade-in allowance of $1,100 on something I have a book value at $800. So it sounds like I have a $300 gain in that case. What I'm being given as a trade-in allowance relative to the book value. So In this case here, I can go ahead and build the entries. So the first thing I'm going to do is put the new equipment on the book. So you see the second debit there, equipment, and it's helpful if you label it in parentheses new or old to keep straight track of that. So the new equipment is going to go on at its market value of $5,000. That's step one. Step two, I'm going to remove the old equipment. So I'm going to debit accumulated depreciation for $3,200. I'm going to credit equipment for $4,000. Third, I'm going to record my payment of cash. So I credit cash for $3,900. And then I recognize the gain or loss. In this case, a gain is a credit of $300. Now I'll double check. Both sides appear to equal $8,200. So debits equal credits. I probably haven't made a mistake here. So I would definitely encourage you to do the practice problems for Chapter 10 before you start in on the homework. They'll definitely help you. And if you have any questions, of course, as always, please don't hesitate to email me. It's been a pleasure teaching you this quarter, and I look forward to seeing those of you that move on in accounting in future classes. Thank you.